Do you really have enough to retire before 60? Retire too early and your savings could run out, wait too long and you risk wasting your best years. In this video, let's unpack what you must consider when planning to retire between 55 and 60. Hey, I'm Chris Trano, founder of superguy.com.au and managing partner at Toro Wealth. Our vision is simple, to be Australia's most trusted retirement planning firm. If you're new here, hit subscribe for regular retirement planning tips. And remember, this is general information only, not personal advice. An early retirement means more freedom, but also more financial trade-offs. Let's unpack 6 important factors to consider before you take the leap. Number 1, no access to your super before 60. For most Australians, superannuation stays locked away until age 60. At that point, you might start a transition to retirement pension for partial access while you keep working. For full access, you'll need to meet a condition of release like permanently retiring, leaving a job after 60 or reaching 65. You can then choose how to draw on your super either as a lump sum or through regular income stream like an account-based pension that provides ongoing payments. Because super isn't accessible until 60, anyone retiring earlier needs a plan to fund those years from other sources. So what do you live off if you can't touch your super? Let's look at the income sources you'll need to bridge the gap. Consideration 2, how to fund your retirement before age 60. If you stop working before 60, you'll need other income sources to bridge the gap until super and the age pension become available. Common options include cash savings and term deposits. High interest savings accounts or term deposits can cover short to medium term needs without market risk. Investment income, dividends from shares or managed funds, such as ETFs, can provide regular cash flow. Rental income, an investment property can generate rental income but comes with ongoing costs and responsibilities. Part-time work, even a few days a week can help stretch savings and provide social connection. You might even use one or a mix of these income sources to fund your retirement before 60. Have you mapped out exactly how you'd cover the gap years before super kicks in? What's right for you will depend on your financial position, how much risk you're comfortable with, and your goals for retirement. If you're wondering which income streams could suit your lifestyle, don't miss my video on 6 types of retirement income streams. The link's in the description. But it's not just about how you fund retirement before 60, it's also how much of that income the ATO takes. Let's look at that next. Number 3, how tax affects early retirement. Early retirement doesn't just affect your income, it can also change how much tax you pay. As we mentioned before, if you retire between 55 and 60, you'll rely on income outside of super, and this income is taxed in the same way as your salary or wages, up to 47%. Even early super withdrawals, available only in limited circumstances, will usually be taxable too. From age 60, however, most super withdrawals become tax-free. So retiring earlier doesn't just mean you'll need more savings, you'll also lose more to tax, which eats into your retirement funds faster. And tax isn't the only hurdle. There's another major one. Consideration number 4, no age pension until 67. Here's a quick refresher on how the age pension works. The age pension age is 67 and you can only apply up to 13 weeks before you reach it. It's means tested. Centrelink looks at both income and assets. They'll assess earnings, investment returns, and apply deeming rates. Plus, look at the value of assets like property, vehicles, and superannuation. If you qualify, the full age pension provides a base level of income. If your income or assets are higher, you may only get a part pension. So if you retire at 55, you'll need to self-fund for at least 12 years before the age pension becomes available. The bottom line, the earlier you retire, the more pressure you put on your own investments and superannuation to bridge that gap. Which leads to the big question most people have. How much superannuation do you need to retire before 60? To give you a benchmark, the Association of Superannuation Funds of Australia, or ASFA, has a retirement standard. According to their latest figures, a comfortable retirement at age 67 means having around $595,000 if you're single and $690,000 if you're a couple. These figures assume that you own your own home, draw down on your super and receive a part age pension. But if you retire earlier, say at 55, you'll need a much larger balance to self-fund your lifestyle for longer. Based on ASFA's benchmarks, that means $850,000 for a single person and $1.175 million for a couple. Why so much? The reason is simple. Retiring earlier means your money has to stretch further, possibly for 30 years or more. If you're retiring closer to 60, I've run those numbers too. Check the video, the link is in the description. Of course, these are just averages. you may need less or more depending on your personal circumstances. To know if your retirement plan stacks up, you'll need to consider modeling your unique retirement situation. To see what retirement could look like for you, you'll need to model it using retirement projections. So what exactly are retirement projections? Well, they're long-term forecasts that show you how your finances could play out over time based on where you're at now and your retirement goals. And they'll usually factor in things like your super balance, savings and investment, income sources such as the age pension, rental income, and part-time work, your desired lifestyle and expected retirement expenses, one-off costs like travel or medical expenses, life expectancy and health factors, assumed investment returns, inflation, and future cost of living. To model your situation, a good starting point is to use free tools like Money Smart's Retirement Planner, and the link is in the description below. Just enter your details and tweak the settings to reflect your situation. Projections will show you 3 key things. 1, how your balance might change over time. 2, how much you could spend each year. And 3, the age your savings might run out. At Toro Wealth, we use more advanced modelling designed around your individual circumstances. Here's a quick example of how lifestyle choices can change your saving needs. Say you're planning to retire at 58. How much super would you actually need? If you aim for a modest lifestyle covering basics, little travel, and a few extras, ASFA suggests you'll need around $35,000 a year for a single person. If you prefer a comfortable lifestyle with regular holidays, dining out, and private health insurance, that jumps to around $53,000 a year. Over 20 years of retirement, that's a difference of nearly $380,000 in spending. And remember, that's just the minimum. If you retire at 58, you may need to fund yourself well into your 80s or even 90s. The takeaway? Lifestyle choices like how often you travel and whether you keep private health cover can massively impact how much you need to save. When you picture your retirement, is it modest and simple or comfortable and full of travel? And have you run the numbers for both? If you're considering retirement before 60, this modelling is even more critical. The extra years before access to super and without age pension support can make your plan look very different from retiring at age 60 or 67, for example. Numbers and modelling are only part of the picture. There are a few other areas you'll want to think about if you're planning to stop work before 60. Let's start with reviewing your investment strategy. If you retire at 55 to 60, your money may need to last 25 years or more. And that means you can't afford to be too conservative, but at the same time, you'll want to gradually reduce exposure to market volatility as you approach retirement. And the key is balancing growth with preservation based on your age, risk tolerance, and how soon you'll need to start drawing down on your super. Then there's debt. Carrying debt into early retirement can add unnecessary financial stress. Focus on paying off high-interest debts like credit cards or personal loans first, then look at reducing or paying down your mortgage. Estate planning also matters. Keep your will up to date and review your powers of attorney in case you're unable to make decisions down the track. Don't forget, your super doesn't automatically form part of your estate. Ensure that your beneficiary nominations, such as a valid death benefit nomination, are up to date, so your super goes where you intend. Healthcare planning is another big one. If you retire before 60, you won't yet qualify for concessions like the Commonwealth Seniors Healthcare Card, available at 67. That makes private health cover and savings for medical costs even more important. Gifting and asset transfers. If you're considering gifting money or transferring assets to family, be mindful of Centrelink's gifting rules. These apply for up to 5 years and can affect your age pension entitlements later on. And finally, emotional preparation. Retiring at 55 to 60 isn't just a financial decision, it's a major lifestyle shift. Work often provides structure, purpose, and social connection. So think about how you'll replace those elements in your daily life. Whether it's volunteering, hobbies, part-time work, or spending time with family, planning activities give you purpose, and routine is just as important as planning your finances. Look, retiring before 60 isn't simple, but it can be done with the right plan. It takes strong savings, discipline, and a strategy that reflects your circumstances, not just industry averages. For personalized guidance, a retirement financial advisor can make all of the difference. And that's exactly where our team can help. At Toro Wealth, we help Australians 55 and over optimize their financial position in the lead up to retirement. To learn more about our service, head over to torowealth.com.au. If you found this helpful, make sure you subscribe so you don't miss the next video. Thanks for watching, and I'll see you on the next one.